First, I want to start off with something. We're going to put up a chart right now, the S&P 500 chart. It broke below a key area of support at around 43.30 last week. What are the charts telling you? What do you see in this charts about the direction of the market going forward?
Sure, Frank. So when you look at a market breaking the key support, which was right around 43.25, 43.35, what it tells us is that prior support becomes a resistance going forward. So today we could, I don't know, if we have a good rally in the day, we could test it. But I think we're going to struggle with that level. Start of October. October can be a volatile month. So what I think happens is we stall around that level and perhaps trend down towards the 4,200. Why is 4,200 important? Well, think about this. It's a rising 200-day moving average. It's a 50% retracement of the rally from March into July. And it's also where we broke out from in June. So I think that's very important. I mean, if things get really volatile, and sometimes October is known for that volatility, maybe you need to see a 61.8 retracement, and that would get you towards 4,100. But for now, we're thinking 4,200 should be a reasonable area to start thinking about, you know what, maybe we can find some support here. And as long as we're above that, I think the equity market could be fine for Q4.
So just to be clear, today's 200-day moving average is now the area of support for the market, where previously it was up here at 43, about 43.30, 43.25 or so.
Yes, exactly. Yeah, so we broke out above last August high and then retested it and broke below it. Right. So yes.
So here on the show, I know you watch.
Yep.
We've seen a lot of seasonal weakness, and we've talked about a lot of seasonal weakness, kind of a September slide for equities. You're actually looking at the 40-day moving average. We don't talk about this very often. What's that telling you, and why is that meaningful?
Okay, well, yeah, the next chart's actually the 40-week moving average and the 200-week moving average. And it's important because we look at cyclical and secular trend. So cyclical trend is defined by the 40-week moving average, which is rising, as you can see on this chart here. And then you got the 200-week moving average, which is your secular trend measurement. So we believe we're actually in a cyclical bull, secular bull. So what we like about what's going on in the market here is we had a correction in a secular bull market, and we moved back above the 40-week moving average. This reminds us of past periods. COVID, China trade war in 2019. Isn't that interesting?
That is interesting.
You know, then you got this correction 15. Remember this? Brexit, Trump getting elected. Looks very similar to what's going on here. And finally, Eurozone crisis, 2 tests of the 40-week. So right here, right now, if we do that and we do it successfully, guess what? Rally here. This rally wasn't as strong. This rally is pretty good. Perhaps we could go to new highs if this pattern stays in place.
Okay, but we're doing this off historical precedent.
Right.
One key difference is interest rates, of course.
Of course, yes. So I guess the real question is, when are people going to feel comfortable enough to say, you know what, I want to invest in stocks and not just continue earning 5 to 6% on cash? That's the big question. If that turns, then I think that happens.
So a bit of a different scenario, but technicals show potential for a bullish trend to the upside for Q4.
I do think that's the case, yes, because when you follow seasonality patterns, especially when you're up year to date through Q3, you tend to have a strong Q4, yes.
All right, so we want to go to your next chart right now. So according to your research, one thing that we need for an October rally is capitulation.
Right.
So give us a sense. This is the VIX relative to the VIX. Give us a sense of what capitulation in this instance looks like.
Sure. I think what's setting up here is this. Last week, people thought maybe we had a climactic low, but we did not get to an oversold reading on the 3-month VIX relative to the VIX, which would mean that the VIX gets higher than the 3-month VIX. Investors more fearful now versus 3 months down the road. That would move that below 1. That's your capitulation signal that we need. We did get one last October. No, yeah, right in here. I think that's where it was. We had a close signal in March. And I think right here, right now, similar to the S&P 500, the 3-month VIX versus the VIX has a resistance around 1.08 to 1.1. So as long as we're below there, I think the risk is, or the potential, is that we get this capitulation signal where the VIX gets above the 3-month VIX, moving this ratio, 3-month VIX versus the VIX below 1, and that would be your tactical climactic signal. And it happened last October as well. And guess what? I mean, it triggered a good seasonal year-end rally. Right. And I think either way, we're probably set up for that. But I'm more confident in those situations when you actually get people, saying, hey, I'm done with this. Let's move on to something else. And then they miss the rally. I mean, that's what happens often, right?
Okay.
And then people play catch up.